As we go into the final quarter of the year, this is the perfect time to take a look again at your tax strategy. On today's episode, we're going to look at how you can optimize your real estate portfolio and treat it like a real business. I'm Kathy Fedke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fedke, the real estate investor's resource.
Today, I'm bringing back Clint Coons from Anderson Advisors. He's an active real estate investor and attorney and owns a CPA firm as well. We're going to discuss powerful moves you can make before year end to lower your tax bill and set yourself up for success in 2026. Clint, welcome back to The Real Wealth Show. If you would, just remind our audience who you are and what you do.
I'm an attorney and real estate investor. And what my firm does is we assist real estate investors all over the country put together structures to not only protect their assets, but at the same time, reduce taxes on those investments. So it's a multifaceted approach that we take in working with investors just to make sure they're maximizing their return on their investments.
And Rich and I have been working with you for years. We've known you for years, and your creative strategies have been so helpful. Things that our former CPAs didn't understand or didn't know. So having the right counsel is so important. I can't emphasize that enough. And you guys, you've just been great for not only us, but many, many, many Real Wealth members. So now we are getting close to the end of the year. Can you believe that? I mean, close from an accountant's perspective, because you don't like getting calls probably on December 26th, I'm guessing. Yeah, and we've done it. Trust me, we've done it. Yeah. But right now, people have time to plan for the rest of the year and get those write-offs they may not have known about. So what are the top 3 things people should be looking at right now?
Oh, wow. Top 3. Well, it depends on what you're doing. Typically, I mean, the easiest one, we may talk about this later, is going to be looking at your real estate and determining whether or not you should do a cost seg with bonus depreciation on that to pick up some losses for this year that you can use to offset your other forms of income. Other things that we look at.
And let me just stop you there so that we,
Okay.
for those who don't know, cost seg is cost segregation. And if you will just in a couple sentences, explain what that is and how that benefits people.
Yeah, so what cost segregation does is allows you to take a piece of property and you break up its components into either 5, 7, or 15-year assets. And what that means is that these items, let's say it's your landscaping, for instance, it has a useful life of 15 years. So you're able then to put that on an accelerated depreciation schedule rather than having to deduct it with the property over 27 and a half years, which means it takes you longer to use that up for tax purposes. You can deduct it over a shorter period, what they call its useful life. So that would be 15 years. Or your countertops, maybe that's a 5-year property that you can deduct in 5 years rather than 27 and a half. So as real estate investors, what we do is we take our real estate and we have a study done to analyze it and determine how much of that property contains these particular categories of assets. And when that study is completed, they'll tell you, well, you've got this much of 5-year property because you have an HVAC system and carpet and flooring and fixtures and all that. And that amounts to $70,000. And then we have your driveway and other things on the outside of your house. And that amounts to $30,000. So you have $100,000 that you can depreciate either 5 years over 15 years. But then you bring bonus depreciation in, and that allows you to deduct it all in year one. Now, there are some rules to be able to use that against other forms of income, but it's often one of the missed deductions that people don't realize to reduce their taxes. And going into that a little deeper, if any real estate investor is considering a remodel on a brand new house or a new property they acquire, then there are some strategies as well you should consider before year end. Mainly put it into service before you do the rehab work. So you can double up on that cost seg that I just described to you. So there are things that we find after the year end where people say, oh yeah, I bought this property and I rehabbed the property and now I've put it into service and I'm going to do a cost seg on it, meaning they started renting it out. That's what we mean by put it into service.
Yeah.
And it just pains me because had they just reached out to us, I would have said, put it into service, rent it out. Or you don't even have to rent it. Just try to rent it.
Yeah.
And then you can do the rehab work. And before you do the rehab work, we'll do a cost seg and then we'll do a cost seg after you do the rehab work. And so you can double up on this stuff.
Ooh. Oh, wow.
It's called a partial asset
See?
disposition.
I
Yeah,
learn from you every time. I feel like
there
I
you
do
go.
these interviews all the time and I know everything. And then you come along and I realize I know nothing. So this is
Well, it's the one that
amazing.
pains me. Yeah, people.
Yeah, you see it all the time. Okay.
Mhm.
So what if you could still buy a property by the end of the
Mhm.
year and do this? Can you do it with the properties you already own?
You can. Now, the bonus depreciation is where it gets tricky.
Yeah.
So, with bonus depreciation, the 100%, which allows you to take that and compress it all down into 1 year, well, you've got some options. If you bought the property after January 19th of this year, then it qualifies for the 100% bonus depreciation. If you bought the property from between 2018 and January 19th of this year, it still qualifies for bonus depreciation, but it's not 100%. It's only 40% for this year.
Because it's like
So
a
you got to be
last,
careful
yeah.
on how take the
You know
deduction.
what? People get this wrong a lot. I've had actually CPAs get this wrong. So thank you for clarifying that.
Well, I better add an asterisk to it. Now,
Okay.
when I say you get 40%, in reality is if you bought it in 2018, it still qualifies for 100%. So does 2019. So you do get to go back and look at the year in which you acquired it.
Mhm.
So gets a little muddy, but the thing is that's why you want to talk to a cost segregation expert because they'll
Yes.
let you know.
Yeah, yeah, absolutely. Okay. So the point being that it's just almost it's October, right? And
Mhm.
you have time. You have time. You don't have time if you call Clint on Christmas Eve. Okay. I've done that and it's not nice. So get your plan ahead of time. So that would probably be the next thing you would advise people to do before the end of the year is get your
Well,
plan.
if you've been running your business as a sole proprietor, maybe look at setting up an S corporation with a 401k plan to start, parking some money inside of there before the end of the year. You can get up to $70,000 depending on your income into that 401k. So that would be an option that I would look at. Health savings account contribution would be another one that would make sense. Paying deductible expenses. So here's a great strategy. Here's something I did one time. So I was working with this person who was flipping real estate, and they had sold a lot of property on installment sales, which means that they rehabbed it and they sold it to a homeowner, and the homeowner didn't give them the full $150,000 for the house up front
Mm.
because the flipper was acting as the bank. So they were essentially financing it to the buyer. Now, the problem with someone who flips real estate is that you're considered to be a dealer, which means your homes are treated as inventory. And
Mhm.
the implication of that from a tax standpoint is that when you sell that house to that buyer for $150,000, let's say you have $50,000 in capital gains. Well, when you're only receiving money over time, generally an investor, if I sold it for 150, I might recognize $8,000 in taxable income this year because my basis, I get to recapture part of that. I don't have to recognize all the gain in year one. I recognize it as it comes in from that sale. But if you flip, it's all recognized in year one, even though you
Mhm.
didn't receive it.
Yeah.
So here was the dilemma. I'm working with a client. They have all this phantom income on their tax return, and they're wondering, what do I do here? We're in November to help reduce it. So one strategy we recommended was, well, set up a C corporation, set it up on a fiscal year end, which means it doesn't end on December 31st. Let's set it up so it ends on September, at the end of September. And what we're going to do then is we're going to enter into a marketing agreement where your corporation agrees to handle all the marketing of your properties for you. Now, in exchange for that, we have two options here. You can go the $12,000 a month payment plan, or if you prepay it now, your corporation is going to cut you a discount and knock it down to $10,000 a month. Just like you
Mm.
see with computer programs and things like that that are on a
Yeah.
monthly billing. If you pay up front, you get a discount. So what this strategy was designed to do, and which people can do, is you prepay certain expenses and they become deductible in the year in which they were incurred. So we were able to pick up a $100,000 deduction for them to help offset that income. And there's lots of things like that, deductible interest. You could be looking at insurance, things of that nature. Pay it before the year's up.
Great stuff. Love it. Okay. So, when is the best time for someone to meet with their accountant to get their plan? Is it the beginning of the year? Is it the middle of the year? Is it now? I mean, I know you guys are all busy with the October 15th deadline, I imagine.
Correct. Whenever you get around deadlines, it's too late.
Yeah.
Obviously, yes, beginning of the year is always a great time. After the October 15th deadline, November, if you've been delaying, you're a procrastinator, well, let's see what things you've missed, because invariably what it comes down to is once we turn the year, people start reaching out and they're not thinking about 2026, they're thinking about 2025.
Mm.
And that doesn't
A
help
little
us,
late.
right?
Yeah.
Yeah, it's too late.
Okay. Yep. So November sounds like a slow month, a time where
Mhm.
a CPA is going to have time for you. Just, I imagine too many people also come around March and think they can get, some time, and that's going to be really hard. That's probably the marathon for most accountants.
It is. And at that time, I mean, you're dealing with what's already set in stone. So
Yes.
there aren't any planning opportunities for 2025 when you're talking to us in 2026. But if you talk to us in 2025, we still have some runway left that we can work with to put things in place to get you the deduction this year.
And now every accountant is different, and some charge sort of a membership fee, some just their normal hourly rate. But I think there's still clients that think they should get that counsel for free, and they might. But my guess is that that's probably the value they get as well. Right. So what can you expect to pay for those planning sessions?
Well, normally, I mean, pricing wise,
I guess it's going to depend on the client, right? And the
it's going to depend on
complication.
the
Yeah.
client, but it's going to be a
Hmm.
couple $100 an hour easily is what you're
Yeah.
going to pay. But if you look at, think of it as an investment. Okay. So what you're talking about there is that cost mindset. And that's something about my father. He has this cost mindset and he says, I'm not going to pay that. And he
Exactly.
doesn't,
Well, I hear that a lot, and I'm like, oh,
right?
you're going to save 10 times that if you 100 times that if you just do it.
Exactly. And that's where, people get themselves into this position where they'll lament the fact that they're not saving anything, and they'll complain about their CPA, but then they won't pay their CPA,
Yes.
or they won't pay someone who's a strategist. They'll pay someone who's a preparer and expect to get a strategist out of it. They're completely different individuals.
We talked earlier about that, awesome bonus depreciation and cost seg and depreciation in general. I think let's start with, can you get that bonus depreciation on a long-term rental, or does it need to be a short-term rental?
It applies to both types of rentals.
Okay.
The distinction between long-term versus short-term has to do with how you can use that deduction that you're able to generate from this, accelerated depreciation with the bonus on top of it. And so if you're an investor that has a lot of passive income, then looking at cost segregation with bonus depreciation, it makes sense because you can take the losses that you generate on paper and offset against all your other rental income. Now, if you're a busy professional and you bought a couple of rental properties and you're looking to take those paper losses that you can accumulate through this strategy and you want to apply it to your W-2 income, then you want to look at ensuring that your property is set up as a short-term rental and that you're meeting material participation rules, which basically means this: you spend 100 hours working on that property, and that 100 hours is more than anyone else. And the average rental period is 7 days or less. And so what we see here at Anderson, we're working with our clients, is that certain individuals, they have a lot of passive income, so bonus depreciation accelerated works great for them just to offset that. That's what I have for my rental portfolio. So I use it to offset that. I don't need it to offset my W-2 because I just have too much passive. But if I didn't have that, then I'd look for ways in which to use it to offset my active, my W-2 income. And that's where the short-term rental comes in. And that makes a lot of financial sense for those individuals.
But if you're like me and you're a real estate professional, so
Right.
most of what I do is real estate, then it can work on the long term as well.
Yeah. So in the long term, if you're a real estate professional, then you're doing the same thing. You're looking at 50% of your time, 750 hours a year is devoted to real estate related activities. So you have to qualify as a real estate professional. Once you've done that, Then what you'll do is you need to meet the material participation test, which is the 100 hours that I described, or 500 hours in general. And then once you've met those requirements, then you can take any of your real estate losses and use it to offset your active income. Now, here's a caveat, though, that sometimes people miss. In order to make that the most useful for someone who's a real estate professional, you need to make an aggregation election on your tax return. If you do not make this election, and what it means is that you treat all of your real estate as one activity. If you don't do that, then what the IRS will do is they'll apply that material participation test, the 500 hours or the 100 hours that I described, per property, rather than
Oh,
aggregate.
yikes.
Yes. So that's when you don't want to miss. And then where it gets even more tricky is that if you're doing short-term rental and long-term rental, you need to segregate your properties. And that's why entities can be really effective for people who are doing both. So we have the short-term segregated from the long-term because we do not want to aggregate the short-term with the long-term.
Okay, if you all are not convinced yet that you should not try this on your own, please don't file your own taxes. If you own real estate, it's a business. You need to treat it like a business and don't try to guess on your tax returns. And also make sure you've got a CPA that is experienced in real estate and understands these things, because as many CPAs as we know, Rich and I still got stuck with one that didn't understand these things until we found you. So make sure you've got the right person. All right. You mentioned earlier the C Corp, the S Corp, LLC. How do you choose and for what?
Well, it depends on what you're doing. So if I'm purely passive in nature, I have a couple of short-term rental properties or some long-term rentals or maybe a mix, then you're going to set up a limited liability company. And generally, you're going to treat that as a disregarded entity. And so that means everything flows down onto your 1040. These are pass-through entities. And you want to preserve that flow-through status. And you do not want to lock up any of those properties inside of any entity that is treated as an S or a C Corp for federal tax purposes. We save the S and the C corporation tax status for active business activities. For passive activities, we want an entity that is disregarded to us or as a flow through, say through a partnership. And so that is a common mistake. Sometimes it does arise with investors. They have an S corporation that they use for a business 10 years ago. They never closed it down. They think, you know what, I'm going to start buying rental property. I'm going to stick it inside of my S corp because I've just had this entity floating around. And then what occurs 2 years from now, they want to refi a property and they deed it out to themselves. That's a taxable event. Yeah, taxable event.
But if it's an LLC, it's not.
Well, I mean, an LLC can be treated as an S corporation. If it's an LLC treated as a disregarded entity or a partnership, it's not taxable. Or here's a better scenario. Let's say that you have the property, it's inside of the entity. You go to your local community lender, you obtain a loan, you do a cash out refi on your property, and you receive $120,000. And so you distribute it out to yourself to go buy another property. With an LLC that's treated as a disregarded entity or a partnership, say it's a husband and wife owning it, that cash out, that's non-taxable to you because you borrowed the money. Well, if you had that same property set up in an LLC treated as an S corporation, you got $120,000 in income that you're taxed on. So S and C Corp is going to do the same thing to you. So you have to be careful on how you structure these deals because you may not understand the unintended consequences of using the wrong tax status.
Good stuff. All right. While we're on that topic, what are some of the biggest mistakes that people make that they get caught on from the IRS? I always hear it. Well, you could get away with anything as long as you don't get audited, right?
Yeah, right. And there's fewer IRS agents supposedly, so the likelihood of being audited has gone down. Not necessarily. In fact, people who file 1040s, your risk of being audited is much, much higher than someone who files a business return. And that's why, for investors, we like to run all their activities through one holding LLC. So you have all your property LLC set up here and it all points down to one holding LLC, and we treat that as a partnership. So what I was talking about earlier with the cost segregation and bonus depreciation, that's the one that's absorbing it, because it reduces your risk of audit, because it's the one that takes the deduction and flows it through to you on one line item. But to your point, what causes the audit risk? Well, that's one of them. When you take all your real estate, you put it on your 1040, you file a Schedule E, and you're taking a lot of deductions, you're probably going to raise someone's eyebrow, because these agents that are not experienced see this and say, well, that can't be right. They can't write all that stuff off. So that can be a potential red flag. Home office, that's another one where people will maybe overstate how much of their property is being used as their home office. That's why we prefer to use the Augusta rule, and just rent your house to your business entity and take the benefit that way, rather than deducting the home office. Your rental log. So if you're a short-term rental, that's a big problem, because the average rental period has to be 7 days or less. And so this goes hand in hand with that depreciation we're talking about, because now what you're doing is not only you deducting your income or all your passive income against these losses, now you're taking those excess losses and you're applying them to your active income, your W-2. So for people who are engaged in the short-term rental space, you really have to keep good guest logs, reservations, tracking all that, because you're going to have to prove not only the average rental period was 7 days or less. That's why you got to have all these logs here, but also you want to keep track of who went out and worked on your property to always show that you meet the material participation test. And then basis tracking, that comes down to your property itself when you're selling assets. Keep good records of how much you put into these properties, because when you go to sell, if you put in $80,000 and now you're claiming you only have $10,000 in gain because your basis was so high, there can be a big problem there if you get audited and you can't back that up. And then the last thing I guess that comes to mind is just 1031s. Making sure you're not screwing it up. You working with a qualified QI, qualified intermediary, to make sure everything's documented properly and the chain of title's the right way. There's a lot you can do with 1031s that many people are not aware of when it comes to buying the replacement property. So you want to get with a professional to talk about that, but you can screw it up at the same time.
Good stuff, and so much more. You always you do 2-day seminars where there's more and more of this good stuff. So, Glenn, thank you so much for being here on The Real Wealth Show and sharing your insights. And thank you for joining me here on The Real Wealth Show. You can get a whole list of resources like Clint on our website at realwealthshow.com. And if you want a direct link to contact Anderson Advisors, just look in the show notes. I'm Kathy Fedke. Thanks for joining me here on The Real Wealth Show, and we will see you on the next episode.
Views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.